Hello and welcome to Business Today. I'm Siddharth Zarabi and you're watching Rajniti, the show where we talk about politics as well as policy. And on today's episode, we are going to talk about the latest moves of the Reserve Bank of India and the Monetary Policy Committee with respect to setting interest rates. It's the beginning of the fiscal year. Just 8 days have gone, and this was the first monetary policy review. The Reserve Bank of India and this committee meets at least 6 times every year, so practically every 2 months. It's a bi-monthly review where the Reserve Bank of India decides on interest rates as well as the stance that it is going to take as far as supporting growth is concerned. Today's policy was very special because this was the first policy after the Ukraine war and the impact that we have seen on crude oil and other commodity prices. And as expected, Reserve Bank of India Governor Shaktikanta Das spoke at length about what we believe is the RBI's reason and rationale for putting growth before inflation. Let's take a quick listen into what Governor Das had to say.
We have taken measures towards rebalancing liquidity conditions while ensuring that our actions are nimble and proactive but well-timed. Now, 2 years later, as we were emerging out of the pandemic situation, the global economy has seen tectonic shifts beginning 24th February, with commencement of the war in Europe, followed by sanctions and escalating geopolitical tensions. We are confronted with new but humongous challenges: shortages in key commodities, fractures in international financial architecture, and fears of deglobalization. Extreme volatility characterizes commodity and financial markets. While the pandemic quickly morphed from a health crisis to one of life and livelihood, the conflict in Europe has the potential to derail the global economy. Caught in the cross-current of multiple headwinds, our approach needs to be cautious but proactive in mitigating the adverse impact on India's growth, inflation, and financial conditions. We are, however, reassured by the strong buffers that we have built over the past few years, including large foreign exchange reserves, significant improvement in external indicators, and substantial strengthening of the financial sector, all of which would help us to weather this storm. Please note that I'm emphasizing on 3 different aspects which places us in a position that would enable us to deal with the emerging crisis and the challenges. The first, significant improvement in the external sector. The second, foreign exchange reserves, which are at very comfortable levels. And third, substantial strengthening of the financial sector. So concerns over protracted supply disruptions have rattled commodity and financial markets. Given the significant share of the 2 economies engaged in war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. I repeated this sentence so that there is clarity in, there is clarity in our communication. Global crude oil prices briefly crossed $130 per barrel, touching their highest level since 2008, and remain volatile at elevated levels despite some recent correction. Global food prices, along with metal and other commodity prices, have also hardened significantly. Risk aversion towards assets of emerging market economies has increased, leading to large capital outflows and depreciating bias in their currencies, that is, currencies of the emerging market economies. These developments have, first, ratcheted up the projections of global inflation, which was already running well above the target in the major countries, and second, will produce sizable adverse impact on output across geographies. The geopolitical tensions have exacerbated at a time when the global economy was grappling with a sharp rise in inflation and consequent monetary policy normalization in major advanced economies. Global supply chain disruptions and input cost pressures are now expected to linger even longer. The resurgence of COVID-19 infections in some major economies in March and the associated lockdowns run the risk of further aggravating the global supply bottlenecks and input cost pressures. World trade and output and hence external demand are likely to be weaker than envisaged 2 months back. Overall, the external developments during the past 2 months have led to materialization of downside risks to domestic growth and upside risks to inflation.
So you heard the governor, and what does it mean really for the average Indian who is struggling with high retail fuel prices, also with inflation going up in most goods and services that he or she consumes? The backdrop to this is the 2 years of the pandemic. That was a completely unusual situation. It was a black swan event, as it is called in economic terms, a situation where all manner of productivity, growth, all business activities had come to a complete standstill due to the lockdown. And we saw one lockdown, another one, and the Indian economy being like that train really, which was picking up a little speed, and then there was one more stop and then one more stop. So unlike a express train or a bullet train, the economy became a train which was practically stopping and starting due to too many red lights being seen all over the route. So what has the RBI and the MPC done today? There were a lot of people who were expecting that from green light it will become completely red, which means that the RBI will raise interest rates, the policy rate, which is currently at 4% and was not changed today. The second expectation of people was that the stance of the RBI would shift from being accommodative, which it has been for the last 2 years, accommodative to support growth, because reviving the Indian economy was the most important thing. And people were expecting, experts and analysts were expecting, that it will move from accommodative to at least neutral. Neutral means it's not taking a view, it is closely observing the situation and will respond as required. Both of those didn't change, but what did definitely happen was that Governor Das in his speech, and you heard that, clearly said that and hinted towards the fact, and if I can use that as an example, instead of green light turning to red and all traffic stopping, the light turned to orange. So that is the change that we have seen, and the Reserve Bank of India is now very clearly worried about inflation. And in inflation, one of the key numbers that Governor Das spoke about was raising the expected rate of inflation to 5.7%, which is up from 4.5%. So for this year, the Reserve Bank of India is now saying, at the very beginning of the financial year literally, that inflation is going to go towards the upper end of its tolerance band at 6%. At 6% and above, which is where the red light sort of flashes clearly, 2% is the lower end, at which point the RBI has to step in and pump prime growth in the economy. And that is why the sum and substance of the Reserve Bank of India's decision today is that the interest rate signal has turned orange. And why is it important for you? If you're looking to buy a new home, buy a new automobile, or take any other loan, you have to pay a rate of interest to the lending institution. And these lending institutions are completely dependent on the repo rate as well as other factors, including liquidity management by the Reserve Bank of India. And therefore, what the RBI has said, that it remains cautious about growth. It is continuing to support growth because of what has happened in Ukraine. Yet it is now looking very closely at inflation and the risk that it poses to the Indian economy. We'll see how that pans out, because the biggest key development will be how do crude oil prices behave in the days and weeks ahead. Hopefully, the Russia-Ukraine conflict will end sometime soon, and we'll have stability and certainty as far as energy prices are concerned. And we'll come back with more on that. Till then, goodbye. If you've been, thank you very much for watching, and please do not forget to like, share, and subscribe Business Today. We'll see you again. Goodbye.
If you like the video, do like, comment, share and subscribe.